This is a continuation of what we looked at the last day. 2019 higher level Shannon PLC. That's the question there. That's the question sheet as you'd normally see it, all the way down to this information here. We looked at the ratios, spent a good bit of time on how to work out each of them. Again, main thing you need is that list of formulas. Once I know that I'm looking for the dividend yield, I find the dividend per share, put it over the share price, and I have my answer. And if at any point you're not sure about, oh, how do I get this, I'm not giving it in the question, then you go find this one here and you work that out. So there's step by step, you'll find each one of the five. I was just asked there in regards to learning them off. Obviously, look, that's a nightmare. There's a list of how many of them there, and it looks very daunting. Uh, Look, you probably won't need to learn them all off. They're all there. You will get a good few questions under your belt, and you'll get familiar with a lot of them, and you'll almost half remember how to do some of them. And what I always do is, as the weeks go by and as we do return to school, I'll say to you, okay, look at this five here. You've a test on, next Thursday, and you'll have to learn off the five and write them out. And it's just a case of doing that a couple of times and bit by bit, and you get it under your belt. And as I said, there might be 10 or 15 that are might be more important, and you do get used to them. It generally causes very little issues in terms of learning them off. And once you do that, 50 out of 50 is a huge possibility. Second part is the report. Talking about whether, in this case, the shareholders would be satisfied with the performance. And another question, it could be the bank manager. Another question, it could be debenture holders. So you have to slightly change the question depending on what they ask. But for today, anyway, we're looking at the ordinary shareholders, and a lot of it is the same. Most of it stays the same anyway. There's only a few things we will change. So I looked at this before. Again, we've done the ratios, part A, B part. I started the last day with profitability. Again, there's a pile of information here. It looks confusing, but all I said to you the last day was, for profitability, you look at this formula, return on capital employed. And for 2018, the figure that you'll need to find, you would have found it up here somewhere in the fourth part, 9.66%. And 2017, that's given here, 5.8%. So you say what this year's is, you say what last year's was, you compare them, talk about the trend, and then you're saying whether they're profitable or not, and compare it to the risk-free investment and debenture rate. And I know there's a few things going on there, but you will do that for every single question. I have that in black. The reason I have it in black is that is what you say for every question. The little red piece here, that will change depending on what they ask. So in this case, shareholders will be happy. In another question, you could say the bank manager won't be happy, and so on and so forth. But the numbers here, that stays the same. The debenture rate is 6%. That's given here. Whatever the debenture rate is, it could be 9% in a different question, but the rest of it will stay the same. And all you're doing is you're saying what this year's is last year's. And obviously, look, you'll know by looking at that whether it's going up or down, and whether it's a good thing or not a good thing, and whether they're making a profit. So that's profitability. Again, you get the swing of it sooner than later. There's three here that we look at for dividends. And just to go into a little bit of detail here, because this is an ordinary shareholder, dividends are important because shareholders receive dividends. But if this was a bank manager, dividends wouldn't be as important, and we might need to look at all three of these. But when we're doing an ordinary shareholder, we need to look at all three. Dividend cover, dividend per share, dividend yield. Dividend cover, dividend per share, dividend yield. Up here you'll find all the figures from last year, and then the figures for this year. Well, we already worked out dividend yield and dividend cover, and we would have worked out dividend per share here as well. So all these figures are up here. You'll find all the answers. This is the dividend yield. The dividend per share figure was here, and the dividend cover figure was here. So all I'm doing, I know there's three. I know they're the three. And you'll always know because you'll see them here anyway in the little box as a reminder, and they all say dividend. What's this year? What was last year? What does it mean? So dividend per share last year 5 cents, this year 7 cents. Shareholders will be happy because dividends have gone up. Dividend yield last year 4% given here. This year 5.19%. shareholders will be happy. So again, people don't never need to learn this off. And I can promise you that you do not need to learn this off. You get the hang of it so quickly. You know there's dividend cover, you know there's dividend per share, and you know there's dividend yield. Chances are you'll have worked out all of them already in Part A. In order to get the marks for Part A, you'd have worked out all the figures anyway. All you do is say this year, last year, compare. So you'll note there's only 3 of them there, and dividend and a few others, they can be quite easy once you get into the swing of it. I'm going to finish off the question now. So we've looked at 2, there's 6 in total. One of them that we don't really need to look at too closely, but we will look at the other 3 in a good bit of detail. So for liquidity here, we have 1 ratio. This is our quick ratio has improved. So last year, what was our quick ratio last year? Our quick ratio last year, quick ratio is our asset test ratio. I'll show you the formula list soon. It's the quick asset test ratio. So they've just called it asset test ratio here, but it's also called the quick ratio. 0.86 is to 1. So that's last year's figure. Quick ratio is 0.86 is to 1. Now we haven't worked out this year's one yet. So I'm going to have to work this out. We haven't worked it out yet. I'm going to have to work this out in order to find out these figures. And you have to find out these figures to be a good few marks going for it because you haven't worked it out already. So how do I work out the quick ratio? The same way I worked out any ratio that we've previously looked at before. You have this formula list. It's down here. It's one of the liquidity ones. You can see here it's called the asset test ratio or the quick ratio. And this is the formula. Current assets minus closing stock is to current liabilities. So current assets minus closing stock is to current liabilities. How do I work it out for this year? All the information is here. Where's my current assets? Below here. 150,000 is my current assets. The formula was current assets minus closing stock. Where's my closing stock? It's not given down here. They didn't include it, but we found it up here. So current assets minus closing stock, 150,000 minus 60,000 is 90,000. And I'm putting that in relation to, so it's in ratio, current assets minus closing stock is to current liabilities. My creditors falling due within 1 year. These are my current liabilities, 84,000. They've only listed trade creditors, but that's the total that they give. So it's 150,000 minus 60,000 is to 84,000. And again, you don't need to write. What I generally get people to do is to do these workings just after at the side. You know, you can fill it in somewhere else. I wouldn't include it in the middle of the ratio here. So I could just show you up here and just, you know, put it out for quick ratio is 150,000 minus the closing stock of 60,000 is to 90,000. Or sorry, it's 84,000. And they've given all this information here in the question. They're the 2 and the closing stocks above. So 90,000 is to 84,000. Divide by the smaller one. So 90,000 divided by 84,000 is to 84,000 divided by 84,000, and you'll get into the swing of just quickly doing that out in the calculator, and your answer is 107 is to 1. So 107 is to 1, that's my answer. So that's my quick ratio for this year. Again, the workings for this kind of stuff, I would highly recommend you to show them, but just don't do them in the middle of the report. The report isn't supposed to look like that. It's not really for rough work. It's a report that you're submitting to somebody. So last year's is 0.86 because they told us that here. Remember, it's called the quick or the asset test ratio. And this year's we just worked out to be 1.07. So this year's is 1.07. Okay. So what happened? Last year 0.86, this year 1.07. We want this to be around 1 is to 1 or just above it. So this is a positive trend because it's gone up from below 1 is to 1. It was 0.86 and now it's gone above 1 is to 1. So this is a positive trend. It would please shareholders Again, this part you'd change if it was a bank manager or whatever, because you're not going to talk about shareholders. So this ratio is above the minimum ideal ratio of 1:1, so it's a good thing. Again, a couple of things that you'll have to say here. You'll have to say this for every single question. If they're above 1:1, they do not have a liquidity problem, because it means their current assets, apart from their closing stock, the rest of their current assets are still bigger than their current liabilities. And that's a good thing, because they're not short on cash for the future. So they do not have a liquidity problem. For every euro Shannon PLC owes in the short term, it has a euro 7 cent available in liquid assets. You say the same thing every single time. All you do is obviously you use the figure they gave last year, you use the figure for this year, say whether it's above or below the ratio, and then obviously if it's above it, they don't have a liquidity problem, and for every euro they owe, they have a euro 7 cent. Or in another question, it might be for every euro they owe, they have 86 cent last year, which would be a bad thing, and they would have a liquidity problem. But in this case, it's above 1:1, so it's a good thing. So this improvement indicates Shannon PLC will have no difficulty in paying shareholders a reasonable dividend. Again, this part's in red because it's directed towards shareholders. Different question, it could be phrased differently. So that's the liquidity here. Again, what have I done for liquidity? I've used the quick, put it in caps lock just so you know, quick asset test ratio. So I found this year, last year, like always, I've compared. So I've compared this year to last year. I've said that it's gone up, so to please shareholders. I've compared to ideal 1:1 or above ideal ratio. I mentioned that literally the second you start mentioning these things, they give you marks. Do they have liquidity problem? And again, all you're saying is that in this case, they do not have every euro they owe. I know I'm writing a lot here, but I find it helpful to maybe state these kind of as bullet points. Every one, I'm going to type in 1 euro they owe, they have whatever amount of euros, in this case is 1.07, and this indicates an improvement. They have no difficulty in paying a dividend, and that's a part that we're going to kind of include for the shareholders here. We mightn't talk about that as much if it was a bank manager. So again, most of the stuff, all you have to do is you have to remember which ratio you need to use. You're generally given last year's figure, this year figure as well. You'll work out and you compare them, and you'll know that this is the ideal ratio. And if it's above it, they're all good. If it's below it, they have a liquidity problem. This is just stating some of the stuff that you have above as well. So again, maybe writing this down to the side, away from the question, but just for yourself as kind of this is the stuff I need to be talking about, a brief kind of synopsis. And again, at the end of this, I'll ask you to take down all of this stuff into your notes copy for this question, because the next question you'll do, you're more or less using most of this stuff. You're really repeating yourself quite a bit, just changing the numbers in most cases. That's liquidity. So gearing is the next one. So in this case, I'm saying, okay, so what about, again, gearing? There's a formula here. We haven't looked at it, but we're looking at last year's figure and we're looking at this year's figure. So where am I getting all this information? So gearing last year was 56%. Okay, so we know that. That's easy. They just already, it's black and white. It's given to us there. Where am I going to figure out this year's gearing? Because I haven't figured it out down here already, and we haven't actually looked at this, I think, yet. So gearing is here above in my gearing section. It's the first one. It's my debt to capital employed. It's my gearing ratio. And this one might take a little bit of understanding. What it is it's debt capital divided by total capital multiplied by 100 over 1%. But again, these figures here, so what's the debt capital and what's the total capital? So this is how you work it out. This is every single question this comes up. These ones here, These are some of your most important formulas. They'll always, every single question you have to talk about them. So you'll always get to know these. So my debt is my loans, debentures, and preference shares. So loans, debentures, and preference shares. So that's my debt. I'll look at that first. Loans, debentures, preference shares, up to the balance sheet. Whereas the loans, they should be here, financed by, they're not there. Instead, there's a debenture. So there's no loans. The debenture, 250,000. So loans, debentures, preference shares. Preference shares are down here, 250,000. So my debt was the first thing. It's loans, 0. Debentures, 250,000. Preference shares, 250,000. So I'm going to include this again, rough work up here. I'm just going to say gearing. It's my debt capital is loans, debentures, plus preference shares. So my loans, debentures, and preference shares. My loans again were 0. My preference shares, again, I've just pointed them out in the question, were 250,000. Sorry, and my debentures and my preference shares. So if I add up all that, it comes to 500,000. I have my debentures, preference shares, and there's no loans. So my debt capital adds up to 500,000, 500,000. What was the other part? Total capital, capital employed. So the bottom part here is capital employed. So capital employed, we're looking at this here, my balance sheet. This is the information you're given here. This is not capital employed. Charlie, I'm just going to highlight that with you there because I've seen you've kind of included this as capital employed a couple of times before. It's this figure, 1,087,000. That's my capital employed. This guy right here. So your debt is your loans, debentures, and preference shares. Your capital employed is this guy. This line here, the very, very, very bottom of every single balance sheet, that's called capital employed. 1,087,000. So I know that my debt capital added up to 500,000. My total capital is equal to capital employed. The last figure in balance sheet. And so I know that my capital employed is equal to 1,087,000. So what's the formula again? Debt divided by total capital. So back to this here, my debt is 500,000 and I'm dividing that by my capital employed. I'm multiplying by 100 over 1 and it's going to be equal to 45.99%, which I'm going to put equal to 46%. Just to put it out here. I'm just going to round up to 46%. So last year's it was 56%. This year it's 46%. So the gearing, remember now, we're just talking about the same things that we previously talked about. Last year's 56, this year's 46. So what do I talk about? Gearing has improved. It's gone from being highly geared last year at 56% to be lowly geared this year at 46%. I'll get to that in a second. The firm is now financed more by equity than it is debt and is not dependent on outside borrowing. So the gearing formula actually looks upon if you have a business and the business is worth that amount, that's the worth of the business, capital employed, it's worth $1 million. How much of that is financed by loans and how much of it is financed yourself? And the loans is the debt. The debt is the money you owe. So you want to find out basically the worth of the business is 1,087,000. How much of the worth is financed by debt? And in this case, it's just less than half. And that's exactly where we want it to be. We want it to be below 50%. So again, for gearing, what are we looking at? My gearing ratio. Gearing ratio, I have this year, I have last year, and I want it to be ideal. It's 50% and below. So last year was 56, this year it's 46. So it's improved. It's gone down and it's improved. The firm is now financed more by equity than it is by debt. So if it's less than 50%, that means that obviously most of it, just over 50%, sorry, not most of it, just over 50%, 54% of it is financed by the business itself, and their debt makes up 46%. Whereas last year, their debt made up 56%, and that was highly geared, that was bad. So this year, 46%, it's below the ideal ratio, which is brilliant. The firm is financed more by equity than debt and is not dependent on outside borrowing. So again, what does this mean? Financed by again, my keyboard kicks in and out sometimes. Some of the keys aren't working here. So financed by debt, or in this case, it's financed more by equity than debt. Okay, so again, all I've done here is I'm talking about gearing ratio. This year, last year, it's below the ideal ratio. What does this mean? It's financed more by equity than debt. Okay, so that's the top part. The bottom part is interest cover. So interest cover is the second one you talk about for gearing. So the interest cover last year, this year. So what are we talking about? Interest cover last year, 4.3 times. My interest cover from last year was 4.3 times. What's my interest cover this year? So I'm not giving it so far. We didn't get to calculate it yet. Wasn't one of those things we've done that we've seen this before. But we're going to go through it. The formula is net profit before interest divided by interest equals times. So here's the question. Here's the figures from this year. There's my net profit. So it's net profit before interest divided by interest equals times. So again, I'll go up to my workings. Interest cover. I know the formula is net profit before interest. So this is my net profit. But I got to this point by working my way down and taking away interest. So my net profit before interest is basically the profit I had before I took this guy away. So to find my net profit before interest, all I do is I add back the interest. I add back the 15,000. So my net profit before interest is 90,000 plus 15,000 is 105,000 divided by interest. That's not going to work out there, but it's 105,000 divided by 15,000, and that actually equals to 7 times. 105,000 divided by 15,000 is 7 times. So technically I should have brackets there. So you add the 2 first before you divide. 7 times is my total. That's my interest cover. What am I doing again? It's improved because I want this to be higher. So it's improved. It was 4.3 times last year. Interest cover last year, 4.3 times. So last year it was 4.3 times. This year I just calculated it to be 7 times. Company is now able to cover their interest charges as the interest cover is above the acceptable amount of at least 2 times. Improving trend would please shareholders and makes the payment of interest easier. So it's always the same, you know, we're always doing the same thing. Interest cover, what have I done so far? What have I talked about? I did this year, I did last year. I stated here that it is, you know, it's gone up, state that it's gone up or down, depending on what happens in the question. If it's above the minimum acceptable rate of 2 times, you want to be able to at least cover, you want your profits to be able to at least cover your interest at least 2 times. In this case it's 7, which is brilliant. So improving trend would, you know, please the shareholders. You know, please shareholders or whoever you're talking about, you know, bank managers or whatever. So it's the same thing again. This year, last year, you know, you're comparing it to the ideal rate. In this case, interest covers, you know, above 2 times, stating where it's gone up. And what does this mean? So again, this is kind of your quick little notes. This is stuff that I'm taking down, just to kind of help you get through it. And the full abbreviation, obviously, the full report has to be taken down as well. The sector. So this here, in the question as well, every single time you'll have to talk about the sector. Now, if I go up to the top of the question, I can see that Shannon PLC is involved in the renewable energy industry. Every single question in the first two lines, they'll tell you what industry they're in. So what you do, because you're talking about somebody, how would they feel about how the company is doing and their prospects for the future, you have to pay attention to what sector they're in. Because if somebody's operating in a sector, like for example, now if I told you this is 2021 and Shannon PLC were an airline company, things aren't looking too well for them. So it doesn't matter what their profits were like in previous couple of years, because of the sector they're in, because they're in the airline industry and the airline industry is struggling at the moment, I have to flag that. So you're just talking about from a real life perspective. Now, I won't go into too much detail because I have this stuff written out and I'll just give it to you. And it's not a case of learning it off. It's a case of just understanding and being able to talk yourself. So renewable energy, I said obviously the renewable energy, there's more energy or there's more focus put into this as the years go by. So, it's a growing industry. It's encouraging. Renewable industry is a growing industry, becoming more environmentally aware. Households can receive grants for installation for solar panels. Long-term prospects are more encouraging as oil supplies are anticipated to be depleted in approximately 45 years. People are actively looking to employ renewable source energy. So, just stating the obvious that obviously in the years to come, the renewable energy industry is probably just going to grow more and more and more. So I'm just trying to state that here under my sector. Don't worry about getting into too much detail. For now, you're just writing it down. And then closer to the time, we'll look at how the different sectors are doing. And to be honest, most of them are doing terrible because of the COVID-19 and all the different measures that have been brought in and the effects on business. But we'll have our little spiel to write about each sector, and there's a few of them that come up again and again. So the very last thing we're looking at, sorry, this is taking a bit of time, but I wanted to finish this question. So the very last thing we're looking at is market value of shares. There's two things we look at here. So first one, share price. So last year was €1.25. This year is €1.35. Where am I getting that information? Again, back up to the question, always at the bottom. Market value of ordinary shares. This year, €1.35. Last year, €1.25. So they give it to you. It's given in this question. Last year's €1.25. This year is €1.35. So what happened? This is the value of the shares. If I want to buy one share, I got to pay €1.35. Whereas last year I would have paid €1.25. That means for the shareholders, if you owned shares last year, every share you owned was worth €1.25, and now all those shares are going up 10 cents. So that's a good thing. So I'm stating here that the share price has risen from 10 cent, risen by 10 cent. Last year's €1.25, this year's €1.35. This is an increase of 8%. If you want, you can work that out. It's 10 divided by €125. You're finding out how much it's increased by. So again, it's an increase of 8%, and what does that mean? You talk about it. So the trend is likely to continue based on this year's performance because they're doing well, and obviously this will please the shareholders as there's confidence. So again, on share price, last year, this year, whatever way you want to do it, you can start whichever one you want. If it's increase is a good thing. And you're talking about the trend that it'll probably go up, and obviously if it goes down, it's a bad thing and they'll be worried. The only other one we have here, just to finish on the question, is price earnings ratio. So this is to do with shares, and this is current earnings. Again, all I'm doing is last year, this year, and talking about it. But what am I going to do for this ratio? Because this one's going to be a little bit more complicated. Price earnings ratio. So if I go up to the question, I worked out the price earnings ratio already, part V. So if I go right up to the top, I can see that I worked out the price earnings ratio was 9.64 years for this year. That's why I stated below here that for this year, price earnings ratio was 9.64. But what about last year? Where is it? It's not here. And generally, they'll give you one ratio, that they'll leave out one ratio, and you'll be expected to find it. So how do I find a ratio for last year? Because I don't have the P&L and balance sheet for last year. What about if I go to the formula list? What's the price earnings ratio? So price earnings ratio is down here. Price earnings ratio, this is how you work it out. Share price in cent divided by earnings per share equals years. So share price in cent divided by earnings per share equals years. Let's look at my figures from last year. Share price in cent, €1.25, it's 125 cent, divided by earnings per share. So even though they don't give us the P&L and balance sheet, you'll be expected sometimes to work out one of these, and you'll already be able to work it out because of the information given. So because my formula is share price divided by earnings per share, share price divided by earnings per share. So 125 divided by 10, and that's going to work out to 12.5. So for last year, again, I'll just show here, earnings per share, just so that you have it, and you can take this stuff down as well as kind of workings for last year. So it's share price divided by earnings per share for EPS. Share price last year was €1.25, it's 125 cent, divided by 10 cents. So 125 divided by 10, and that equals 2 years, 12.5 years. So that's that worked out there. That's the workings. You just do that to the side, do it above the question, or the sheet after you've all this done. A rough sheet in the exam. So last year was 12.5 years. This year we worked out already up here. We were asked to find it. So we had it worked out to be 9.64 years. Price earnings ratio, you want this to be lower. So price earnings ratio last year was 12.5. This year is 9.64. This will please shareholders as it means it will take a shorter period of time for an ordinary shareholder to recover his or her investment. So earnings ratio, we're looking at seeing, okay, how much you've invested in the company and how long until you earn that back. So obviously if you earn it back in 9 years, that's quicker to earn your money back compared to 12 years. So that's a good thing. So we want this to be low. So again, my price earnings last year versus this year. Again, you're commenting on the two. We want this to be low. It means you recover investment quicker. So you're talking again saying that this will please shareholders because you're receiving your money back in a shorter period of time. Now, obviously this is a longer video than I usually do, but again, this is the share price, this is the earnings per share, or the price earnings ratio. Again, last year, this year, talked about it. The sector, this is a case of just going through well, I'll go through this eventually. You're just taking this down for now. We're not looking in too much detail. Gearing ratio, interest cover. Similar story, I've written it out already. And liquidity is my quick ratio there, my asset test ratio, where I worked it out. And I have my little spiel that I'll always include as well. So there's a good bit of work this week. Again, take your time going through the video. I'm going to get you to do the 2016 question I gave you. I'm going to get you to finish that off again, but I think that question is Dorothy. I'm going to get you to finish that question off, but again, it's very, very similar. So I'll give you instructions on Google Classroom.